You've probably felt it at the grocery store checkout line or when looking at the interest rate on a car loan. The cost of daily life and the cost of borrowing money to pay for it rises. When prices consistently rise over time, we call that inflation. If prices and interest rates are highly unpredictable, families can't set a reliable budget, and businesses hesitate to invest in new equipment or hire new workers. When instability crosses from one household to the next, it evolves into systematic risk, a danger that can compromise the structural integrity of the entire economy. In a fragmented market, no single bank or business can guarantee broad stability for everyone else. Preventing a total system-wide freeze requires a dedicated manager to provide the unshakable foundation that individuals and firms cannot create on their own. This diagram outlines a central bank's role. Sitting at the top, it monitors and protects money, financial institutions, and markets. In the U.S., that manager is the Federal Reserve, bridging the gap between high-level markets and everyday households and businesses. Congress gave the Fed a specific set of marching orders known as the dual mandate. They are tasked with promoting maximum employment alongside stable prices. Stable prices don't mean zero inflation. The target is a low, predictable inflation rate of about 2%. If inflation hits zero or turns into deflation, existing debts become harder to repay, which stalls economic growth. To hit that 2% target, the Fed might raise interest rates to slow down spending, but raising rates can also slow down job growth. Balancing those two opposing needs is the central tension of every decision the Fed makes. This graphic breaks down the Fed's two primary roles. First, on the left, it acts directly as the government's bank. The Fed holds an exclusive legal monopoly on issuing U.S. currency. By controlling the supply of money, it executes monetary policy to influence interest rates and overall credit conditions. Secondly, the Fed also operates as a vital bank for private banks. In this role, the Fed runs a payment system that settles roughly $4 trillion in transfers between banks every single day. It also serves as a lender of last resort, offering emergency loans when private lending freezes during a crisis. To ensure everyday savers can trust the banking system with their deposits, the Fed closely supervises these local institutions. By holding both of these responsibilities, the Fed acts as the ultimate backstop. It provides the mechanical foundation that keeps the broader financial system running. If one institution holds all that power, there is a risk of it becoming too centralized. To prevent that, the Fed is divided into three distinct administrative parts. At the top is the Board of Governors in Washington, D.C. The 7 governors serve 14-year terms, a timeline specifically designed to isolate their decisions from the short-term pressures of 4-year election cycles. This map illustrates the second part, 12 regional reserve banks, drawn in 1914 for diverse representation. From New York to San Francisco, they serve specific district needs and funnel local economic data back to national leadership. The third piece is the Federal Open Market Committee, or FOMC. As seen in this official statement, the FOMC votes to set the target range for the federal funds rate, the major policy decision you hear about in the news. First, national leadership. Second, local data collection, and a central voting committee. The structure forces different perspectives to collaborate, balancing power by design. Despite its influence, the Fed's jurisdiction has hard limits. It does not control the stock market, and it has no authority over the government's budget. The economy is steered by two separate drivers. The Fed, in the blue car, controls monetary policy by adjusting money supply and interest rates. Congress and the President, in the green car, control fiscal policy through taxes and spending. The Fed can change monetary policy quickly and independently. Fiscal policy, on the other hand, moves slowly and is heavily subject to political debate. True economic stability requires both of these drivers to navigate the same road. If they steer in opposite directions, the entire system struggles to advance. The rules of the road create built-in friction. Politicians frequently face pressure to increase short-term spending to win elections, while the Fed often requires long-term patience, like keeping rates high to suppress inflation. We saw this friction clearly in 2018, when President Donald Trump launched a public pressure campaign, heavily criticizing the Fed's decision to raise interest rates. That pressure was aimed directly at Fed Chair Jerome Powell, challenging the central bank's mandate to operate free from political interference. This debate over independence is an ongoing reality. In May 2026, Kevin Warsh was sworn in as the new Fed chair, stepping into a role where balancing economic data and political scrutiny is part of the daily job. The Fed can raise interest rates to slow down rising prices, but if the government concurrently floods the market with new spending, those two forces essentially cancel each other out. Ultimately, the central bank cannot successfully guard the dollar's value if fiscal policy is actively diluting it. This video is for educational purposes only.